Our featured guest during the close, David Bianco, head of U.S. equity strategy at Bank of America-Merrill Lynch Global Research. David, I want to kick things off with you. David, Charles Biederman just making the point that we've never had a rally, this strong a rally, that we really don't know who's doing the buying. You kind of agree with his assessment?
Well, I agree that this is an extremely strong rally, one of the strongest market rallies since the Depression. But we know indeed who's doing the rally. If you look at the Bank of America-Merrill Lynch Global Fund Manager Survey, institutional equity investors worldwide are buying equities. That's one of the biggest bullish reads we've seen on that survey in years. We haven't seen retail participate in this rally yet, but institutional investors are clearly buying.
David, that's a great point. We had Ed Yardeni on last week, and he talked about gridlock and how that's kind of definitely a positive here going forward. You agree that basically maybe nothing big, dramatic will get done when it comes to health care and maybe financial reform and so on?
Right. I'm not sure gridlock is the right word, but I think investors are certainly encouraged by signs that this administration might be more balanced in the actions they take when dealing with certain industries, whether it be healthcare and hopefully the financial sector as well.
What about, though, those worries that are out there? And I think about the growing deficit that's out there. There are still some questions. There are some folks out there, whether it's Steve Roach and a few others, Paul Krugman, that say maybe we could see a double dip. I mean, David, does a double dip factor in at all in terms of your outlook here, be it on the economy and the markets?
Well, I'd say at this stage the market is priced at levels that suggest that it does not expect a double dip. If we were to have that, that would take the market down. But we're not expecting a double dip. We're expecting 3% GDP growth for the next couple of years. One risk to that thesis is a surge in interest rates, but we're not expecting that.
That's a good point. I mean, David, are you nervous at all about anything when it comes to the outlook here? I mean, we're kicking into earnings season. We're waiting for IBM that's going to be out after the closing bell today. I mean, the earnings environment certainly improving, but still, what makes you nervous here when you look at the outlook?
There are plenty of things that we monitor, whether it be interest rates, government deficit spending, keeping a careful eye on what's going on in Asia, the pace of growth in China. These things are important. We're encouraged by the signs of corporate spending on technology. We think we're going to continue to get good earnings reports out of technology companies. But the things that matter for the S&P are looking good. We're mindful of the many challenges still facing the overall U.S. economy and U.S. consumer.
And David, this is something you mentioned earlier about that international buying of U.S. assets. I mean, that's really providing some support here in terms of the gains we're seeing in various asset classes.
We actually don't see investors buying, we do not see foreign investors buying U.S. assets, but we see U.S. companies making strong profits with their businesses abroad. That's certainly helping the S&P.
David, what's your take here? What do you want to see out of earnings? Is it that top line growth? Is it visibility, better visibility, more visibility? What?
I'm sorry?
What we're looking for out of earnings season is some top-line growth, and we're seeing it. We expect to see 2% top-line growth year over year. I know that's nothing impressive, but the first quarter of 2009 was still a steep recession. Sequentially, I think, is the way to think about top-line growth, and we're expecting over 6% top-line growth sequentially. So you're getting top-line growth, and it's being led by those sectors of the S&P that are most foreign exposed. Listen, I think that earnings season is going to be good. Most investors know that now, but my message is buy on the rumor and also buy on the fact, because I think you're going to have many more quarters to come of improving quarterly earnings at the S&P. We're early in this recovery cycle. I think we're going to have several years of economic growth and earnings climbing higher.
Surprise, maybe, we had some selling on Friday, some gains here, nice rally here on Tuesday. Are we going to see this kind of trade in your view?
Yeah, I do think, fortunately or unfortunately, depends on how you're using the volatility. I think the volatility will continue. We've seen the VIX come down from the historically high levels, but we're still above normal, and I think we're going to stay above normal. And the way we saw on Friday, with a lot of conversation out there regarding just how strong will earnings season be, plus there's a lot of questions being asked about proposals regarding taxes on the financial sector. Listen, there's a lot of uncertainty still out there. The economy, politics, volatility will continue, but my message is stay bullish, use it as opportunities to buy.
Hey, David, let me talk a little bit about groups that you like. I mean, energy, we're not really talking about a lot of energy earnings this week. We're focusing on the financials. Actually, let's start with financials. I mean, you got from Citigroup, you heard from JP Morgan. What are you anticipating that we're going to hear from those financial names?
Well, we've heard from a couple of bellwethers already, a couple more yet to come, as you said. Energy's later in reporting season. The sectors I like, are financials, energy, and industrials. I'm looking forward to hearing from the industrial companies and their orders and their outlook for 2010. With the financial sector in particular, it's not the earnings for the fourth quarter. There's a lot of one-time issues related to TARP payment. The issue is how strong have they built up their loss reserves, and when do they think the loss reserves are going to peak, and how much earnings growth can they generate over the next couple of years?
David, if I can just pose the question to you. Again here, you were talking about earnings strength, top-line strength that you're looking for specifically. Is cash flow also something that you're considering when you're looking at valuations?
Yeah, of course it is. The value of a business to us is all future cash flow that it can generate. But something that's important to keep in mind is that one of the reasons why free cash flow is strong relative to earnings is because companies aren't making investments for the future. They've pulled back on their CapEx. I'd like to see them put a little bit more money into CapEx. I think they will.
David, let's start with you. I mean, so 2010 looks like what their forecast is better than what analysts were expecting. They're beating here on both the top and the bottom line. This is the kind of numbers you want to see in an improving economy. Is that right, David?
Yeah, it is. It's not as much growth or improvement as you would expect from technology companies in general, given the severity of the recession. And that's partly because of how well many of these big cap tech companies did in sustaining their earnings during the downturn. But listen, it's great earnings. It's great cash flow underlying those earnings. And just look at the PE. There's a lot of these big cap tech companies, premier businesses, leaders in what they do, trading at valuations that just don't reflect the quality of the business or the growth prospects.
Well, you talk about the quality of the business. IBM ending 2009 with $14 billion cash on hand. At the end of September, it was about $11.5 billion. David, that's another sign that companies, should we see any kind of further weakness or slight weakness, I mean, these companies, a lot of them have a lot of cash on hand to kind of cushion any future downturn.
That's absolutely true. There's simply no banking crisis at the non-financial companies in the U.S. or the S&P. And I think you'll see these companies continue, as they gain more confidence in the outlook, to take advantage of still depressed valuations, make acquisitions, repurchase shares. And these companies are in a very advantageous position.
I mean, the expectations have been growing progressively over the last few months. So even if we see a company like IBM beat on the top and bottom line, there could be some investor disappointment here.
And that's why I would say I think the only objective way to think about that issue is to look at the PE. We could talk all day long about whether the earnings were enough or shy of built-up expectations. But if the earnings on fourth quarter annualized or the 2010 earnings, if they're very credible and the PE looks reasonable, remember, we're in a low interest rate environment.
Right.
We have to be reasonable in our expectations.
And